Large-scale industrial growth requires permanent capital. To build a physical, long-term project like a modern automotive assembly line, a company needs massive funding that stays locked into machinery and infrastructure for decades. Individual savers, however, operate on a different timeline. While they have surplus cash to invest, they require the flexibility of short-term liquidity, needing to know they can access their money immediately for personal emergencies or changing needs. This creates a direct conflict. If savers refuse to part with their funds for 20 years, businesses cannot secure the capital, and expansion stops. To bridge this gap, financial systems utilize the security, a legally transferable contract of ownership or debt. This invention allows a saver to own a portion of a company's assets and share in its potential growth or interest payments. This diagram shows the macroeconomic function of that invention. It maps the flow of funds directly from the households with surplus income into the business firms that need that capital to produce goods and services. By turning a massive industrial debt or ownership stake into thousands of small tradable contracts, the securities market transforms idle savings into productive growth. Capital formation begins at a specific zero point called the primary market, the moment a security is born. In an initial public offer, or IPO, a company issues new equity shares in a direct exchange for an investor's cash. This is the only time the company itself receives money from the sale of these specific shares. The business now captures that cash permanently, using it to fund its long-term physical expansion, like building new factories or researching new technologies. While the investor now holds a contract with the potential for long-term growth, their actual cash is no longer accessible. It has been embodied in the company's physical assets and equipment. The primary market creates the factory, but it traps the investor's wealth inside it. For the system to remain attractive to savers, there must be a secondary escape route. That escape route is the secondary market, the stock exchange. This infrastructure solves the individual's liquidity problem without draining the company's capital. When an investor needs their cash back, they sell their security to a new investor. The cash moves from buyer to seller, not out of the company's bank account. This lateral transfer ensures the factory operates smoothly, uninterrupted by the changing ownership of its shares. While early markets relied on the physical exchange of paper tickets on crowded floors, modern digital systems have increased the speed and volume of these transfers by orders of magnitude. The secondary market achieves a technical feat. It allows a long-term corporate asset to behave like a liquid short-term asset for the individual. Making this digital trade safe requires a layer of invisible infrastructure. Depositories act as the central vaults, dematerializing paper certificates into electronic records to ensure ownership is accurately tracked. Behind every trade is a clearing corporation. This entity acts as the ultimate guarantor, legally stepping in to settle a transaction if the buyer or seller fails to deliver. This trust allows institutional investors, including pension funds and mutual funds, to trade at a massive scale, providing the depth of buyers and sellers necessary for instant liquidity. Without these intermediaries and the scale they provide, the link between savers and businesses would fracture, making it impossible to move capital efficiently. The primary and secondary markets are inseparable. One cannot function without the other. If the secondary market did not guarantee an easy way to sell, no rational investor would ever provide the initial funding required for a primary IPO. The securities market is an intentionally engineered ecosystem, a perfectly interlocking mechanical gear system designed to match idle savings with productive business needs. By holding these securities, investors earn a return through dividends or interest, while the value of their contract can appreciate as the underlying company grows more profitable over time. This mechanism allows individuals to accumulate personal wealth through the growth of the broader economy, while simultaneously providing the permanent capital that builds the modern world.